Welcome to our Hurst Cycles webinar for the 28th of November 2016. My name is David Hickson, and as always I must ask you to please read and make sure that you have understood these disclaimers. A big welcome to everybody from all over the world. We've been looking at people all their different locations. We have people from all over the world joining us today. Thank you very much for joining me live. And in today's webinar, I'm going to be speaking about the concept of a dual analysis, which is a new feature that Sentient Trader is able to perform. A dual analysis is in fact two analyses on a single chart. And I introduced the concept of a dual analysis several months ago when we released the new version of Sentient Trader, and I've spoken about it in webinars previously. But I've often rather sort of skirted around the details, and in today we're going to focus on those details and spend the entire webinar speaking about the concept of a dual analysis, what it is, why it's important, and why it can really help you to understand what's happening in the markets, I believe a great deal better than if you were working with a single analysis. If you have any questions, please do ask them. I'll do my best to answer those questions as we go. Let's get started and speak about what a dual analysis is. And in order to do that, I'm going to go back in time a little bit and provide you with a little bit of history. And I'm going to first of all show you this chart here. This is a chart that no doubt you're very familiar with. It's a simple representation of a cycle. It is, of course, nothing more than a sine curve. It's been produced in Excel. And that blue line represents two waves of a sine curve, and this is a visual representation of a cycle. So the idea here is that when this line is moving up, the cycle, which is whatever is influencing the price movement, is influencing prices to move upwards. Okay, and when the line is moving down, then the cycle is influencing prices to move downwards. And so each cycle consists of an up move and then a down move, and then it repeats the up move and the down move, and it keeps doing so in a fairly regular manner, and that is of course what a cycle is. So that is a visual representation of a cycle, and we're not going to get distracted here in terms of talking about what cycles are and why they move price movements. So let's just accept that that is what a cycle is. Now, Hurst's cyclic theory differs from other cyclic theories in terms of financial markets for a few reasons, or there are a few differentiating factors about Hurst cyclic theories. But one of the most important ones is that Hurst stipulated or stated that multiple cycles influence the price movements of financial markets. Many other cycle theories about financial markets will identify one cycle, or one cycle at any particular time. That cycle might change, or that cycle might disappear, and another cycle comes back. That doesn't happen with Hurst cycles. Hurst cyclic principles state that multiple cycles influence the price movements of financial markets. And so here is a graphic representation of two cycles. You can see there is a blue cycle and there is a red cycle. So each of these cycles is doing what we expect a cycle to do. It is moving up and then it is moving down, and that's the blue cycle, and here is the red cycle moving up and moving down. Now, this is not just an arbitrary combination of two sine curves, as it might seem to be, but these sine curves obey some of Hurst's principles. Now, the principles are what Hurst defined, and the principles are what really make Hurst's cyclic theories Hurst's cyclic theories as opposed to any other cyclic theory. Often people ask me, why is Hurst different from any other cycle theory? There are many different cycle theories. And the main reason why Hurst cycle theories are different from other ones is because of the principles that he defined. And these cycles have been arranged on this particular chart to obey two of the principles. Well, in fact, three of them, but it obeys two of them with perfection, and the third one not quite so accurately. So the first principle that these two cycles on this particular image obey is the principle of harmonicity, which is that the wavelength of each of these cycles is related by a simple integer value. So what is the wavelength of the blue cycle? Well, if we measure from one trough of the blue cycle to the next trough of the blue cycle, that is the wavelength of that cycle. I'm sure you're familiar with that concept. And the relationship between the wavelengths of these two cycles, the blue and the red cycle, is, as you can see, here's the wavelength of the red cycle. It is twice the length of the blue cycle. So the blue cycle has a wavelength of 1, and so you get 1 and 1, and the wavelength of the red cycle is 2. So what is called the harmonic ratio, which is the relationship between the wavelengths of those cycles, obeys Hurst's principle of harmonicity, which is that the wavelengths of those cycles should be related by a simple integer value of either 2 to 1 or 3 to 1. Okay, so that's one principle that is obeyed by these two cycles. The other principle that is obeyed by these two cycles is the principle of synchronicity, which tells us that the troughs of cycles occur synchronously or at the same time where possible. Now, it is not possible for every single trough of every single cycle to occur simultaneously, because as you can see, the blue cycle is forming a trough over here at exactly the same time as the red cycle is forming a peak. So obviously this trough of the blue cycle cannot be occurring synchronously with the trough of the red cycle. However, when possible, the troughs of these cycles are occurring synchronously, which is why these two sine curves are arranged in the way that they are. Now, I'm sure you're very familiar with this stuff. I've spent a lot of time banging on about using Excel to show these cycles. So let's move swiftly on and take a look at what happens when you combine those two cycles and you apply the next principle of Hurst's collection of principles, which is the principle of summation. The principle of summation is very simple. It tells us that when we combine cycles, we simply add them up. We add them together. And so this green line is the result of combining this red and this blue cycle. I'm sure you're familiar with these charts and with these concepts. As you can see, this is where we get the fact that cycles form M shapes in financial markets. There you can see the M shape. The M shapes that are formed in financial markets because of cycles is not an arbitrary thing. It is because of the specific principles that we're discussing here, which are the principles of harmonicity, synchronicity, and summation. And also to some extent the principle of proportionality. And just as a quick side note, in case you're interested, that principle of proportionality is the one principle that isn't really being applied entirely accurately in these examples. The principle of proportionality states that the amplitude of a cycle, the strength with which it moves prices upwards and downwards, is related or is proportional to its wavelength. So you can see the red cycle here has a greater amplitude because it is causing a greater upward and downward movement. It has a greater amplitude than the blue cycle. But you can see on this particular chart, it doesn't have double the amplitude of the blue cycle. So that's why I say these charts are slightly bending one of the principles, and that's the principle of proportionality. And that is because in my experience in financial markets, the principle of proportionality does not apply directly, as it were. So when you have a longer wavelength cycle, it definitely has a greater amplitude, but it doesn't have double the amplitude, in my experience, of a cycle which has half the wavelength. So I hope that makes sense. So that's what happens when you combine two cycles, and we can continue the process because, of course, Hurst stated that there are an infinite number of cycles that influence the price movements of financial markets. So here are 3 cycles. I won't bore you with all the details, but there's an orange cycle, a blue cycle, and a red cycle. They are obeying the principles of harmonicity and synchronicity, and when we combine them, applying the principle of summation, we get this green curve over here. So this green line is the price line, if you like, or the result of combining these 3 cycles. So here again, you get the M shape that is formed by cycles in the markets. Okay. But here you also get the extra wiggle, which is something that we've spoken about before, which is, of course, the mid-channel pause. That's a very important detail, something that you often see forming in the markets, the mid-channel pause, a very useful thing to be able to identify. So that's the result of combining 3 cycles. And now we can take this even further if I can find the next chart. Here's the result of combining 6 cycles. Now that green curve at the top of that chart is beginning to look a little bit more like a price movement. And if we combine multiple cycles, I think that here I am combining 11 cycles, which is what Hurst recommended one should do when analyzing the stock market, then you get a combined curve like that green line over there. That's the result of combining 11 cycles. Now that is beginning to look a little bit more like a price movement. Why am I going through all of this real sort of basic beginner stuff? I'm going through it all because it's an important thing to understand when we're analyzing our markets, where the ideas come from. And when we're going to start speaking about a dual analysis, it's important to understand what the 2 analyses are doing that is different. A dual analysis, as I've mentioned, is not simply one analysis which is displaying the positions of troughs and peaks. It's not that. It is 2 entirely separate analyses, and you need to understand some of this background information to fully understand the concept of a dual analysis. So here is a stock market. This is the S&P 500. And if you have a look at that price movement, you can see that it exhibits some characteristics which are similar to the ideal price movement, if you like, that we're seeing as a result of this Excel spreadsheet, the combination of these cycles. So the Excel spreadsheet represents the mathematical model, if you like, and of course when we apply the mathematical model to the stock market price, we would like it to match as closely as possible, to know that this is a meaningful mathematical model. Okay, and let me just move this chart up a little bit so that we get all those dates in there. There we go. Okay, so let's just spend a moment speaking about the Excel price movement, the idealized price movement. As I've mentioned, this price movement obeys Hurst's principles, in particular the principles of harmonicity and synchronicity. Now, when Hurst defined the principle of synchronicity, he stated that the principle of synchronicity tells us that the troughs of cycles are synchronized where possible. He didn't mention peaks, he mentioned troughs, and it's a really important point. And when we use those principles to create this idealized price movement, there are some things that we can observe in this price movement that is a result of the particular principles that we've applied. In particular, you will see that we have sharp, isolated troughs. Can you see these troughs? You get very sharp, very isolated troughs. In other words, the troughs stand out all on their own. Okay. On the other hand, the peaks, although the individual peaks are indeed fairly sharp, what tends to happen is that you get clusters of peaks, and those clusters of peaks together tend to create a kind of a rounded peak formation in the market. I hope that you can see that. And so whenever you get a peak over here, although the individual peak might indeed be sharp, the collective formation of the peaks tend to be rounded and clustered. And the troughs are sharp and they tend to be isolated as well. I'm sure you can see that in that price movement. And when we take a look at a chart of a stock market, and this is a chart of the S&P 500 index, so it represents the stock market effectively, you can see here as well, we tend to get sharp isolated troughs. Okay, there we had 2 troughs close together, but generally speaking, the troughs are fairly sharp. and they're isolated. They stand out on their own. Whereas the peaks, can you see how rounded and clustered the peaks are? Okay, most of the peaks that are forming in this market are fairly rounded and clustered. Of course, we do get some isolated and sort of individual peaks, but as a general thing in stock markets, you get those rounded peaks and sharp isolated troughs. I see Pat saying very clear. That's great. I'm going to stop repeating myself. I have a tendency to repeat those things until I've really driven the point home. So that's what happens in stock markets because of the fact that the principle of synchronicity tells us that the troughs are synchronized. Okay, so the principle of synchronicity tells us the troughs are synchronized, and the result of that, I know when I first studied Hurst Cycles, I read the principles and I thought, okay, wow, okay, that's interesting. What on earth does it mean? Or, synchronicity, we've got synchronized troughs. What does that really mean? Well, what it means in terms of our trading of financial markets is that we expect troughs to be sharp and isolated, and we expect peaks to be complex, rounded, clustered affairs. That's what it means. Then I started my Hurst Cycles journey by analyzing stocks. I was living in South Africa and trading South African stocks. I started analyzing and trading stocks. I then started looking at other instruments, and I was working with a New Zealand analyst, a wonderful man called Ray Tomes. You might be familiar with his work. He has his own approach to how cycles work in financial markets. It's called the harmonics theory. A very powerful theory, very interesting theory. I've spent some time in New Zealand with Ray discussing cycles and how cycles work in markets. And there's a fascinating overlap between Hurst Cycles approach and the harmonics theory approach. The two have many points in common and also some differences. But in my work with Ray, I was speaking about the principle of synchronicity and how troughs are synchronized but peaks aren't. And he said, well, yes, but of course in commodities you have the opposite thing. Because in commodities you have synchronized peaks. You don't have synchronized troughs. And I started taking a look at some of my charts of commodities, and let's take a look at a chart of gold. And you will see that generally speaking in gold, and this is not unfortunately a great chart of gold, I'm afraid. It's not a great example, but I think it's going to serve. It's going to serve to illustrate what I'm trying to speak about here. In gold, generally, you get very sharp, isolated peaks. Look at the big peak in gold several years ago. There we go. A big, sharp, isolated peak. Look at the troughs that tend to form in gold. Look at this trough here. You get rounded, clustered troughs. Okay. Again, sometimes you do get sharp, isolated troughs, just as you do get sharp, isolated peaks in stock markets. But as a general feature in commodities, and I would encourage you to explore this idea in your own time. Look at charts of wheat, for instance. Wheat is a great example, and coffee. Coffee is a brilliant example of a commodity. Coffee has very sharp, isolated peaks. If you look at the price of coffee, it rises up to a peak, then it comes down and it forms a rounded clustered trough that comes up to another peak, and so on. And so, mathematically, what is happening in those markets? Well, I believe that in commodities and in precious metals, the cycles are behaving in such a way that the principle of synchronicity applies to their peaks and not to their troughs. Why is that, you might ask? Well, I actually cannot tell you why it is that in a commodities market the peaks will be synchronized as opposed to the troughs. Although Ray suggested that the reason was to do with human emotion. Stock markets tend to rise when humans are feeling optimistic, and they tend to fall when humans are feeling pessimistic, of course. And the idea is that when human beings shift, or crowds of human beings shift from moods of pessimism to moods of optimism, the shift happens very quickly, which is why you get very sharp, isolated troughs. On the other hand, commodities have different emotions associated with them. And for instance, gold is often viewed as a safe haven. So when people are feeling anxious, the price of gold possibly rises. Okay, so again, when you get a shift from anxiety or pessimism into the opposite of optimism, then you will end up getting a sharp peak in gold and a sharp trough in the stock market. Of course, there might be many other reasons why this happens, but the fact is that if you take a look at your charts of commodities, you will be able to identify sharp isolated peaks, indicating that probably the principle of synchronicity is applying to the peaks as opposed to the troughs. So I started noticing this time and time again after my conversations with Ray, and of course I enabled Sentient Trader to perform what we called an inverted analysis. As you can see on this analysis of gold here, we have an analysis of the peaks. Okay, so what Sentient Trader is doing is performing an analysis working with the concepts of the principles of harmonicity and synchronicity, but it's applying those principles to the peaks here. Whereas my analysis of the S&P 500 is applying those principles to the troughs. So it's applying it's applying the principle of synchronicity to the troughs. Okay, so here you can see the normal trough-based analysis. Then, as I was looking at this and studying inverted analyses or peak-based analyses and trough-based analyses, I then asked myself the inevitable question, which is what happens in the case of currencies, of forex pairs. So let's take a look at a chart of the euro to US dollar. Which one is it? I think it's this one here. If you take a look at a chart of the euro to US dollar, and this has got data going back to 1976, I think they're using the Deutschmark as a substitute for the euro before the euro existed. But if you take a look at this chart, you can find examples of sharp isolated peaks and also sharp isolated troughs. You can find some rounded troughs. Is that a rounded trough? It's a kind of a rounded trough. You can find examples of sort of rounded peaks. There's a rounded peak there, although the scale's quite difficult to see it. But you find examples of both of these. Okay, so I asked myself what was happening in terms of forex pairs, and are the troughs synchronized or are the peaks synchronized? And I performed analyses using both methods, peak analysis or inverted analysis and trough analysis, and I found that over certain periods of time, trough-based analyses worked really very well, and over other periods of time, peak-based analyses worked very well. Very seldom did I find that both analyses were working very well at the same time. That's when I came up with the concept of the idea of dominance in a forex pair, and I need to be careful of using that word because of course we speak about a dominant cycle, and I'm not speaking about a dominant cycle in this case. I'm speaking about dominance, and in fact we really need to find another term for this. If anybody has any good ideas, please let me know. But the concept works like this, which is that in the case of a forex pair, you have two currencies, in this case the euro and the US dollar. And there are periods of time when the US dollar is behaving with sort of synchronized troughs. And then there are periods of time when the US dollar is behaving with synchronized peaks. The result is that the forex pair, the combination of the two of them, exhibits periods of time where you have synchronized peaks that are working perfectly, like clockwork. And then you have periods of time where the troughs are working absolutely perfectly because the cycles seem to be working with synchronized troughs. So that's a really interesting concept, and it's one we could discuss. I don't have any answers in terms of why that happens. I really have no idea, but I have found that it does happen in the markets. And so I started looking at the concept of not performing one analysis, but performing two analyses on the chart. The one analysis assumes that the troughs are synchronized, and it gives you a trough synchronized analysis, and the other analysis assumes that the peaks are synchronized, and it gives you a peak synchronized analysis. So let's take a look at some of the detail of that and what that really means. Before we do, let's go back to our Excel chart and discuss the difference between a dual analysis and simply plotting the peaks on a single analysis, plotting the troughs and the peaks on a single analysis. I see a comment from Edda. In my opinion, it is due to the fact commodities have longer cycles and therefore last movements are up or extended due to positions kept too much in counter trend. Base in commodity is due to their harvest characteristic. Okay, so that's a very interesting comment about why it is that you get synchronized peaks in commodities. I'm sure there are many very viable reasons why you get those synchronized peaks. But let's speak about, if you have performed a trough analysis, then what's the difference between labeling the peaks and actually performing a peak analysis? So what we're going to do is come back to this chart here of our 3 cycles, and assuming that we have performed a trough analysis, we therefore know where these troughs are forming. And I don't need to draw the diamonds because you can see the troughs, you can see the cycles drawn on your chart. But let's speak about where the peaks of these particular cycles are forming in price. Now here's an interesting thing, because the peak of this orange cycle, for instance, doesn't occur where the peak of the actual cycle occurs. I'm going to try and draw a dotted line here. You can see the peak in price of the orange cycle actually occurs over here, and the tradition is that we mark that with a diamond. Okay, so let me just quickly change something here. Okay, there we go. That is of course called time translation, where the peak of a cycle in price doesn't occur at exactly the same time that the peak is actually occurring in the cycle. It's a subtle thing, and we won't dwell on it now, but it's a very interesting point to make. So traditionally, if you were going to ask yourself where is the peak in the orange cycle, you would look at the highest price between the 2 consecutive troughs. So here's a trough of the orange cycle, here's the next trough of the orange cycle. What is the highest price between those 2 troughs? This is the highest price over here. So that, therefore, is a peak of the orange cycle, right? That makes sense. It's the highest price between the 2 troughs. Where's the next peak of the orange cycle? Well, we look at the 2 troughs of the orange cycle, and the next peak of the orange cycle in price is over here. Where's the next peak? And so on. Okay, so here's the next peak of the orange cycle, and here's the last peak of the orange cycle. Okay, and you can see the effects of time translation over here as well. That peak actually occurred earlier than the peak in the actual cycle itself. So whatever that cycle is, we don't know what that cycle actually is, of course, but whatever that cycle is, turns, starts moving downwards, and in price, we see the peak in price forming before the peak in the cycle. And on the way up, the peak in price occurs after the turn in the cycle. Makes for an interesting point of discussion. So now let's have a look at the peaks of the blue cycle. So we do the same thing. We say here is a trough of the blue cycle. Here's the next trough of the blue cycle. Where's the blue cycle peak? Well, the blue cycle peak is clearly over here. That's the highest price. Where's the next blue cycle peak? The next blue cycle peak is over here. Okay, and here's the next trough of the blue cycle. Now, where is the peak of the red cycle? Well, that's an interesting point, isn't it? It's the highest price between the 2 troughs of the red cycle. So it could be either here, I'll put a question mark under it, or it could be over here. You can see that because this is an Excel spreadsheet and we have absolutely ideal cycles, those 2 peaks are absolutely equal. So either one of those 2 could be a peak of the red cycle. So this is what happens when you take a trough analysis and you identify your peaks. You're basically finding the highest price for each one of your cycle waves. But now let's speak about this blue cycle in terms of the peaks. Now, generally, when you're measuring the wavelength of a cycle, you will measure the distance between any two respective positions on the cycle. So in other words, you measure the cycle wavelength from one trough to the next trough. Okay, and so let's call that a measurement of 1, and that's a measurement of 1. So that's the cycle wavelength measuring from trough to trough. If we were able to see the actual cycles themselves, the theory is that we could also measure from the peak to the peak, and that would of course also have a wavelength of 1. Okay, my 1s don't look, they don't really sort of stand out as the number 1. Okay, so that's a wavelength of 1 time unit. But now, when we start measuring the distance between the peaks in the actual price movement, which is this green line, then we measure peak to peak distance, and we get something very interesting happening, which is that we measure a wavelength of about a half. Can you see that? Because of the time translation, let me see if I can draw a bit of a dashed line over here. From the peak of the blue cycle to the peak of the blue cycle in price, there's some translation. Okay, the price is actually sort of squashed off to the right, and here the peak in price occurs before the peak in the actual cycle. This is called time translation, and I'm sure you're aware of it. But the result is that when you're measuring wavelengths using peaks, if you measured the distance between this peak over here and this peak over here, you would measure about half of a time unit. And then you would start measuring from here, and then we loop back to the beginning and to here, and you would measure a wavelength of 1.5. So that's why when you perform a trough analysis on the assumption that the troughs are synchronized and you're using peaks to measure your wavelength, you end up with very different answers for your wavelength. The average amount will be the same, okay, because you have 2 cycles there taking place within 2 time units, so you have an average wavelength of 1 time unit, but you get tremendous discrepancy between the wavelengths of your actual cycles. So that's a really important point, that when you have a trough synchronized market and you measure the wavelengths between the peaks, you get much greater variation in the wavelength. Okay, so the traditional way of approaching identifying your peaks in an analysis would be, and let's just go back to the S&P 500 here, is that you would perform an analysis and your trough-based analysis, and you would say to yourself, where are the peaks of all of these different cycles? So, for instance, the 54-month cycle that elapsed from October 2011 to February 2016, that 54-month cycle, that peak was over here. Okay, that's the May peak in 2015. That's the peak of the 54-month cycle, because that's the highest price between this trough here and this trough over here. The peak of the next 54-month cycle we don't know yet, of course. The peak of this bigger 9-year cycle could be either this peak, or it could be the next peak that we're approaching now. Okay, it looks like obviously it's going to be the next peak because we're now at a higher price level. But here is our M shape, which is forming in the market. What about the peaks of these 18-month cycles? Well, you would do the same thing. You would say, what's the highest price between the first 18-month cycle trough and the next 18-month cycle trough, and you would find those highest prices, and those are therefore the peaks of your 18-month cycles. either there or no, probably still coming. So that's the traditional approach in terms of labeling and identifying your peaks in the market. And as I mentioned a moment ago, if you're working with a trough-based analysis and you measure your wavelength between the peaks, so here we have 2 consecutive peaks of the 18-month cycle, you will see you come up with very, very greatly varying cycle wavelengths for those peaks. Here's a peak of almost 2 years, a cycle of almost 2 years measuring peak to peak. And if you measure peak to peak over here, we get a wavelength of only 35 weeks. Okay, so you get a very long cycle, then a very short cycle. So that's the sort of traditional approach. And now that is what a dual analysis in Sentient Trader doesn't do. Because in my opinion, if you want to identify your peaks using that kind of approach, then you can just go ahead and you can do it visually. I mean, you don't really need software to sort of find the highest price between 2 troughs for you. But what Sentient Trader does is it takes a very different approach, which is that it performs 2 completely separate analyses on your chart. So your trough-based analysis is the analysis that you see at the foot of your chart, assuming that your troughs are synchronized. Now we can add the peak-based analysis over here, which is a completely separate analysis. Okay, a moment ago I identified the peaks of the 18-month cycle, and I identified this point here as a peak of the 18-month cycle. And yes, according to my peak analysis, that is a peak of the 18-month cycle. But my peak analysis states that this is a peak of the 54-month cycle. Okay, that's really interesting, because our peak of the 54-month cycle we put over here. Whereas, in fact, according to this peak analysis, that's only a peak of the 18-month cycle. And our next peak of the 18-month cycle we positioned over here based on the trough analysis, whereas, in fact, here we've got a peak of the 18-month cycle over there. So what's going on here? Well, it's because we have 2 completely separate and unrelated analyses. These 2 analyses don't speak to each other, or I should say they don't speak to each other yet, because they do speak to each other when it comes to the concept of zigzags. And we're going to spend another few minutes speaking about zigzags in today's webinar. I had a lot of emails about zigzags because they're a very interesting concept. And so we're going to get there in a moment. But these 2 analyses, the trough and peak analysis, aren't really speaking to each other, if you see what I mean. The peak analysis is not receiving information from the trough analysis in terms of where the 18-month cycle trough or peak should be. It's performing a separate analysis on the basis that the peaks are synchronized. So now here's the interesting point. When I first started doing this, I thought to myself, I'm going to have to come up with an entirely new analysis approach, one that doesn't require peaks to be synchronized. Because when I perform a trough analysis, I'm assuming that the troughs are synchronized, and I'm doing an analysis on that basis. So I thought, well, when I start adding a peak analysis, I'm going to have to take a different approach. It's going to have to say the peaks don't have to be synchronized. So I started off by just simply applying a peak synchronized analysis to see what it did. And it revealed some very interesting things, in my opinion. And that is that although the peaks in the market, in a stock market, are probably not synchronized, when you perform a peak analysis on that market, assuming that the peaks are synchronized, you are provided with some very, very interesting information. So let's speak about what that information is and how you can really use it to start making some better informed, hopefully, better informed trading decisions. So if we have a look at this analysis, and let me zoom in and let me turn off these semicircles that are going to get very messy. Here we go. And I see some comments there. Peter, is the last bull run a market cycle or information shock caused by the Trump effect? Okay, that's a very interesting question, and we could probably spend a long time speaking about it. The Trump effect, or the effect of fundamental interaction, news events on the markets, tend to cause a tremendous amount of volatility. And generally you find that markets then go back to where they were. So let me just take a moment quickly showing you this. Let me hide the peak analysis. If we sort of zoom in here, you can see the markets were coming down to a trough and expecting the 40-week cycle trough. And then for the 2 days before the US elections, the market was bouncing out of a trough that was potentially the 40-week cycle trough. This bar here was the tremendous volatility that surrounded the announcement of the election results. And if you just sort of take that one bar out of the picture, it looks as if though nothing really happened. You just had tremendous volatility for a day. In my opinion, that volatility was really the net result of the Trump effect, that was the fundamental interaction that occurred around the U.S. elections. I know it might seem disappointing. People expect that such a big news event would have an effect for weeks or months afterwards. Of course, that is possible, that it will have fundamental interactions for weeks or months afterwards. But I would tend to take the simple approach, which is to say that was the fundamental interaction on that day, and now it's back to business as usual. But I know there are some people, and probably some people on the call today, who would disagree with that and have other ideas. But let's speak about this peak analysis. The first thing to bear in mind about a peak analysis is that at any one time in the market, I've discovered, or I believe, from my experience by looking at these peak analyses, and I've actually been looking at these peak analyses for about 4 years now, comparing the results of combining the analyses. And what tends to happen, in my opinion, is that one analysis will be very good, and in a stock market you would expect it to be your trough analysis. So that's really where I put my emphasis when I'm looking at a stock market. I put it on the trough analysis because I expect the troughs to be synchronized. And the peak analysis is probably not going to be so good. So let's take a look at this analysis here, just what we can see over here. And let's speak about why this peak analysis is not really so good. Can you see this 40-week cycle peak over here? Can you see where it happened in the market? Okay. And just a couple of months earlier, there was a better, more prominent peak. What is that peak in the analysis? That's only a peak of the 40-day cycle. And the 80-day cycle peak, you can see, is kind of over here in the market. Okay, that doesn't really look very good, does it? And we get this, we get a similar kind of thing happening all the way in this peak analysis. Here's an 18-month cycle peak. That's good. It looks like a very suitable and appropriate 18-month cycle peak. But here's the 80-day peak right down here. Okay, not looking very good. Then we've got a nice big peak over here, and that's only a 40-day cycle peak. And so on. You can look in the detail of the on your own analyses. And you will always find that one analysis will be better than the other at any particular time. Okay, I see a question or two there. Angela, did you come up with a preferable time frame for more accurate turns based on your findings? No, Angela. These ideas apply fairly universally. I have my own ideas about what happens when you go intraday. So, in other words, you can apply these principles end of day. As you go intraday, the same principles apply, but there are quite a lot of other things that happen intraday, such as the different, the different parts of the world sleeping and waking up and trading, which create their own cyclic rhythms, which kind of interfere with the markets. So intraday there are quite a lot of other complex things happening, but the same principles definitely apply across all time frames, with varying degrees of effectiveness. If you're trading intraday, basically you need to be aware of several sort of other added layers in terms of what's happening. Generally, when you're looking at an end of day chart, the markets, always tend to do what the cycles are making them do, even if they are bounced around a little bit by things like US elections and so forth. Whereas intraday, you get a lot more. It's not random noise, interestingly, but it's a lot more sort of noise from other things affecting the markets. And I see David at Trading Hurst. He says, I do actually find this trading the DAX intraday. I'll sometimes turn off the peak phasing in Sentient as it struggles to give a satisfactory phasing. I rarely turn off the trough phasing. Exactly. So, and that it illustrates my point perfectly. That one analysis will always be better than another one. I've never seen, well, very rarely have I seen a chart, particularly an end-of-day chart, where both analyses are both equally good and equally viable. So the first thing you need to do when you're working with an analysis is determine for yourself which is the better analysis. Is it the trough analysis or is it the peak analysis? Let's just take a moment to go and take a look at the euro to US dollar, because currencies are particularly interesting when it comes to dual analyses. Because I believe currencies go through periods of time where one analysis is definitely much better than the other one. I wonder what charts I've got here. Here we go. This is a better chart to look at. And let me turn off those zigzags. We're going to get to the zigzags in a moment. So at the moment, the euro to US dollar, in my opinion, is working very, very well with troughs, not quite so well with peaks. And we could have a look at the details of this analysis, but there isn't really time because we need to move on. But you'll notice some peaks in this analysis, simply aren't really labeled very accurately. It's actually not too bad. I was looking at it earlier and I thought, oh, not very good. But here you've got a 20-week peak, and in the market there was really no peak at all, and so on. So you whenever you're looking at your analysis, you're always going to find one that works and one that's not quite so good. But nevertheless, performing a dual analysis is very powerful, and that's what I'd like to speak about now. And so let's go back for a moment to the S&P 500 and turn my pen off. There we go. So if we look at the chart that we were looking at a moment ago in the S&P 500, what you will find in the analysis, and particularly the analysis that's not working quite so well, is that one of your analyses will look very nice and neat and very well ordered. Can you see how perfect these circles and whiskers are here? In fact, let me just slide this chart over a little bit, and you'll see that one of the analyses generally will have very well ordered circles and whiskers, these nests of lows. See how perfect these little stacks are. That's not necessarily telling us that this is a very good analysis, but it's generally an indication that the analysis is quite nice and clear. The peak analysis, however, the circles and whiskers just form one big sort of mess up at the top of your chart. Okay, the reason for that is exactly what I demonstrated earlier, which is that the cycle wavelengths, when you're measuring a trough synchronized market and you're measuring the distance between the peaks, you get greatly varying cycle wavelengths. You get very short cycles and very long cycles. And so the result is that you get this sort of very messy circle and whiskers up at the top of the chart over here, whereas at the foot of the chart we've got really nice, neat circles and whiskers. Nevertheless, the peak analysis is still telling us some really very, very interesting information. Look at these circles and whiskers here for the 20-week, 40-week, 18-month and 54-month peak over here. And look at what happened in the market during this time. Okay, there was clearly a peak, which formed, when was that peak? I think the peak was in August of last year. There was definitely an important, really, really good peak forming in the market. Now, I know some of you would like your analyses to be 100% accurate, and you're striving for 100% accuracy all the time. My approach, you've probably gathered over the years that I've been doing these webinars and speaking about this, my approach is never to try to achieve 100% accuracy, because I think it's pretty much impossible to achieve. But what you're looking at is you're looking for signs of peaks and troughs forming in the market when you are expecting them. And you're looking at evidence that you can use to tilt the odds in your favor in terms of making your trading decisions. I don't believe we should be striving for 100% accuracy. We should be striving to tilt the odds in our favor. That's really what we're doing. And that's what a peak analysis helps you to do. Despite the fact that it is, really potentially not a very good analysis, it nevertheless gives you very useful information that you can use to tilt the odds in your favor when you're making trading decisions. So you can also, of course, let's take a look at some of these other S&P 500 charts. You can also start playing around with this analysis and look at the different options. Here I pinned the 40-week cycle peak over here, as you can see, and look at this nice circle and whiskers for the 18-month cycle peak right over there when there was a peak in the market. Because prices come up higher, it's indicating that maybe the 18-month cycle peak is only forming now. That is quite possible. Using the dual analysis, you can come up with a whole lot of different variations to your analysis, and I think I've got one here which actually has that peak. There we go. Let me take off the semicircles. There we go. So here we've got the 18-month cycle peak as having formed in August of last year. And so what's the market doing now? Well, it's bouncing up to the 20-week cycle peak. Okay, so all of these possible analyses are viable in terms of what's happening in the markets at the moment. But how do you really use this dual analysis? What's the really useful thing that you can do with the dual analysis? Well, the really useful thing is a tool that you can now work with in Sentient Trader called the zigzags. And so I'm going to spend the last 10 minutes or so of today's webinar speaking about the zigzags, because the zigzags in Sentient Trader are a direct result of the dual analysis. And I spoke about them, I know, in our previous webinar. I hope I'm not going to repeat myself. But the zigzags are really a very powerful tool. Let me show you what tends to happen when you have a dual analysis on your charts. What you do is you choose a cycle. So let's start with our longest cycle that we can see on this particular chart, which is the 9-year cycle. Or in fact, I'm using a short nominal model, so it's the 7-year cycle. So here's a 7-year cycle peak over here, and here's a 7-year cycle trough over there. Now what happens is the price is going to move from the peak down to the trough. But it's not going to do it in a single move. It's going to do it in many multiple moves. And in the sort of simplest way that it's going to achieve this is in 3 moves, which are, of course, the 3 legs of the zigzag. Okay, so we would expect it to move down first, then bounce back up, and then move down again. So most moves are achieved from peak to trough, or from trough to peak of a particular cycle, are achieved with those 3 moves. Okay, and so the next thing to ask yourself is, as price is heading downwards out of this 7-year cycle peak, where's it going to move down to? Well, it's going to move down eventually to the 7-year cycle trough over here. But where's it going to move in that first leg of the move? Well, it's going to move down to the trough of the cycle with the greatest magnitude that it has to reach before the trough of the cycle that it's moving towards. I hope that makes sense. So here is the trough of the 9-year cycle, or beg your pardon, the 7-year cycle. So we know that the price is going to move down there. But where's it going to move to first? First of all, it's going to move to the trough of the greatest magnitude cycle that must form a trough before that 7-year cycle. And that is, of course, in this case, the greatest magnitude cycle trough is the 40-week cycle trough, which is over here. So price will first move down to the 40-week cycle trough. Okay, then it's going to bounce up, and it's going to bounce up to the peak of what? The peak of the greatest magnitude cycle that must be formed before the trough, which is the ultimate destination, if you like, of this zigzag move. So what's the greatest magnitude cycle peak that must form before this 7-year cycle trough is going to form in the market? Well, it is this 40-week cycle peak that forms over here. So price will move up to that 40-week cycle peak and then move down here to that 7-year cycle trough. And that is what happens in markets, and you'll find it happening time and time again. So we can look at another few examples and speak about this move from the 18-month cycle trough. You see the 18-month cycle trough over there, up to this 18-month cycle peak over here. So we expect price to move in 3 legs. The first leg, it's going to move up to a peak of the greatest magnitude cycle peak that it will encounter before the 18-month cycle peak. So which peak is that? It's fairly obvious. It's this 20-week cycle peak over here. So it's going to move up to that 20-week cycle peak over there. Then it's going to move down to the greatest magnitude cycle trough that it must achieve before coming back up to this 18-month cycle peak. So it's going to move down to this 20-week cycle trough over here. And then it completes its destiny and moves up to that 18-month cycle peak over there. So this is how zigzags work. And you find zigzags happening all the way down. In answer to Angela's earlier question, what time frame does this work on? It works on all time frames. I'm showing you this on a very big scale, but it happens happens intraday as well. When you're looking at very short-term cycles, you end up getting a bit of a zigzag move like this. And so of course here I'm looking back in the past. I thought it would be really interesting to see how we might have used this information by looking forward into the future. And so I have an interesting little demonstration of that to show you. Let's go back to the euro to US dollar, and let's see if we can get a little bit of a matching time scale here. Let's turn on our zigzags. Okay, no, it's not actually on this chart that we need the zigzags, it's on the next one. So I'm going to try and get the zoom roughly matching on the other chart, and let's just zoom in a little bit. Let's go from the beginning of November up to what's that date? 17th of April 2017. All right, so this is the euro to US dollar today. You can see according to this analysis, the euro to US dollar is coming down to form an 18-month cycle trough. Okay, and if I display my zigzags, you can see the actual zigzag line is assuming that that trough has been fulfilled. It's something that zigzag lines do. When all the conditions of a particular zigzag have been fulfilled, then it will assume that that trough has formed. That doesn't mean, a very important point, it doesn't mean the trough has formed in the market. You must use your other tools to determine that, but the zigzag tool itself will move ahead and start looking forward. You must never use the zigzag tool as a reason to say that a particular trough has formed or not. You have other much more accurate tools for doing that, FLDs, VTLs, and so forth, and your advanced human brain. So let's take a look at the euro to US dollar. And what I did was I loaded up a chart that I used for a webinar that I did back in February. So what I'm going to do is I'm going to show you what the analysis way back in February was showing us we should expect. You can see the last piece of data on this chart is Friday the 19th of February. Okay, so this is the analysis that we were looking at, and I did have a dual analysis. I had a peak analysis as well. Notice how perfect these circles and whiskers are here for the troughs, but they're pretty good for the peaks as well, but not quite as good. So the peak analysis is a little bit less certain than the trough analysis at this particular point, and we're going back to February. So we're going back, how many months is that? That's 9 months ago. Now, using the analysis from 9 months ago, and I haven't done any pinning or anything on this. This is just the analysis that we spoke about in the webinar in February. But if I display the zigzag, then you can see this is the zigzag for the 18-month cycle. Okay, so in February, this is what we were expecting. And let's just speak about the zigzag, because it's an important thing so that you can understand how you should be working with this tool. So this dashed line, this yellow dashed line, is telling us that, of course, we expect price to move from this 18-month cycle peak all the way down to this 18-month cycle trough. Now, can you see the nest of lows for this 18-month cycle trough? That is centered around the 18-month circle, is actually in the second week of October. Okay, the 20-week circle is a little bit later, the end of October. The 40-week circle is a little bit earlier, but we have a definite nest of lows over here for the 18-month cycle trough. Okay, so back in February last year, we were expecting a zigzag move. And what did we expect? Well, from the 18-month cycle peak over here. And bear in mind that now, when we look back, the 18-month cycle peak might not have been there. But back in February, this is the information we were working with, and this is the analysis we were working with. There's another really important point that I'm going to make here, which is that even if your analysis is wrong, and maybe that wasn't an 18-month cycle peak, maybe that was only a 40-week cycle peak, nevertheless, it tells us to expect similar things from the market. I'll let you work that out for yourself, but we might be looking at a 40-week cycle zigzag here instead of an 18-month cycle zigzag. It doesn't make a huge amount of difference. I hope that makes sense. So the first thing that we expect when price leaves this peak here on its way down to fulfill this nest of lows expected in October or November of this year, the first thing that it's going to do is it's going to move sharply down, and it's going to come down and form a trough of the greatest magnitude cycle that it is expected to form before that 18-month cycle trough, which was, of course, the 40-week cycle trough. So that's why we get that strong move down there. That's the zig, or the first leg of the zigzag. Then we expect it to move up. Can you see this yellow dotted line? That yellow dotted line is showing us what we expect the zag to do, which is to come up to the peak of the highest magnitude cycle that is expected to perform, that is expected to form before the 18-month cycle trough. Okay, so that's why that line comes up to here. And here is the nest of highs. Not a very neat nest of highs, as I've already mentioned, but there's the nest of highs for that 40-week cycle peak. So in other words, we're expecting this leg to take us up to a high, and that high we were expecting to form around about end of June, early July of this year. As you can see, price has come up now into what was looking like, and by now I mean end of February, price has come up to form what was expected to be about a 20-week cycle peak. And then, of course, it's going to come down. It's going to come down to this 20-week cycle trough over here, and then it's going to come up, and it's going to form a peak over here, and then it's going to come down to this 18-month cycle trough. So what these zigzags were telling us back in February, 9 months ago, is that we were expecting the market to come up and fulfill the second leg of the zigzag around about June, July, at around about this level, 112.50, something like that, roughly that level. And then it's going to come down into this circle. And now this circle, the center of this circle is at about 102.50. And you can see the size of the circle. The size of the circle gives us an idea of where the price is expected to come. So if we come back to our chart, which is up to date, and turn off the pen, come back to here. Right, we can see a few things have changed as time has passed. For instance, this trough, this peak over here, is no longer labeled as a peak of the 18-month cycle. The 18-month cycle's moved over here. But the important point is that we were expecting a peak around about June, July. Where was that peak? That peak was in May. Okay, and then we had another peak over here in June. All right, so we had the move down here, then up to a peak over here, and then we had a move down towards the 18-month cycle trough over there. I hope that shows you the power of these zigzags. They give you the real power of it is that because you've got these two analyses, you can start looking at how price moves from troughs to peaks. Bear in mind, as a sort of a conclusion to today's webinar, bear in mind that one of your analyses will always be more accurate than the other analysis. And so you need to sort of focus on the analysis that is more accurate. But you can combine the two analyses by calculating these zigzags, by putting these zigzags on your chart. And you can see how here, way back in February of this year, we would have had a fairly good idea of what to expect in terms of what the euro was about to do looking forward 9 months. So it was a fairly useful projection that we could have made. I see some questions. Julian, we can put zigzag lines into ellipse and we can watch how beautiful the price will respect ellipses axes, major and minor. That's a very interesting idea, to combine them with ellipses. And I see Peter is asking how you would do it. How do you work out the amplitude of the ellipse? I suggest you get onto the forum. I hope that you're all getting involved in the forum and speaking on the forum about these ideas. That would be a great topic to write about on the forum, because it's time for us to bring today's webinar to an end. I see a point I missed from David at Trading Hurst. Another point which might be useful is to realize that the price peak or trough is not always the cycle peak or trough. Use commonality to narrow down your candidates. That's right. That's a very, very important, very important point, and it brings us back to this this chart over here, where we've got the time translation. That the peak of the cycle is not necessarily the peak in price. Okay, you have time translation, so the peak in price is often distorted and it's moved to the right or to the left depending on underlying trend. And as David suggests, you should use commonality between different markets to narrow down your candidates for a particular trough or a peak. And Charles, a question on a tangent: did the recent launch trial version have the CML? Charles, I wonder if you're speaking about Sentient Trader. Yes, Sentient Trader, the trial version of Sentient Trader does indeed include the composite model line, the CML, or perhaps you're speaking about the MetaTrader 4 Hurst Cycles indicators. Those indicators do not include a composite model line. They perform an analysis, but they don't include a composite model line. The composite model line is a feature that is unique at the moment to Sentient Trader, because the calculations involved in getting the CML onto your chart are pretty extraordinary. It does a lot of calculations, a lot of number crunching to work out all the amplitudes of all the different cycles and their varying wavelengths and all that kind of thing to put them into a composite model line. I'm hoping one day we will have a composite model line for the MT4 version, but it's not available yet, simply because of the amount of processing that has to go into producing the CML. But all of these features, in theory, can be developed for the MetaTrader 4 version. And in fact, the analysis information for the MetaTrader 4 version is made available to other indicators. So there's a great possibility for other indicators to be developed for the MetaTrader 4 version of our Hurst Cycles analysis tools. And with that, I am going to bring today's webinar to a close. I hope that you've found it interesting discussing the power of the dual analysis that Sentient Trader is able to perform. Bear in mind that one analysis will always be better than the other, but that in itself gives you useful information, and you know what to rely on more than the other. But there is a great deal of useful information to be gleaned from both analyses, even the analysis that is not as accurate or as good as the other one. So thank you very much for your time. Thank you very much for joining me. And I wish you, of course, profitable trading before I see you at our next webinar, which will be in 2 weeks' time. It will be our last webinar for the year. I look forward to seeing you there, and thank you very much for your time.